Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at Twitter. We're going to go through more information, give you my financial opinion on what's going on out there. Got a lot of quotes by famous investors, so we're going to hit that up. I resonate very well with it, not because I'm the be all end all investor. It's just I think they're right, and it's things that I have found to be true during my investing. We'll call it an investment journey or venture. And I'll touch on some of those points that I think are important. So we'll hit that up. If you guys need any help with anything, definitely check out finding-value.com. It's the website I have developed to help everyone out through this investment journey. Basically, you can follow along exactly what I'm doing. All right, so let's dive in here. This is again, my Twitter, it's at @finding_finance if you want to follow me. And we're going to start with some quotes. So here's Charlie Munger. It says, most people are too fretful or afraid. They worry too much. Success means being very patient, but aggressive when it's time. And I've talked about this quite a bit, about being aggressive when it's time. That is what's going to separate a really good investor versus someone who's average to below average. They get aggressive when you need to. When there's fear in the markets, when there's a really good setup in the markets in terms of technical analysis, market conditions, and ratios, when they all align at a bottom, you can get super aggressive because your risk is the lowest, your rewards are the greatest. And if the market conditions are turning, that's generally when they become successful, is when they start to turn and move on up. Some people call that the inflection point. The inflection point where something goes from losing money to making money, from a downtrend to an uptrend in commodities, from a disinflationary environment to an inflationary environment. Those are all things that you want to get massively aggressive when it's time. And it shows itself with that alignment. And I know a lot of people, they kind of just blindly put money into stocks, and that's definitely not a successful strategy. A strategy will be portfolio allocation, managing your risk through position size, perhaps. That could be one way to do it, and then getting aggressive when you need to be aggressive. So Charlie's definitely on point here. Now here's Warren. It says, an investor cannot obtain superior profits from stocks by simply committing to a specific investment category or style. He can earn them only by carefully evaluating facts and continuously exercising discipline. So these two quotes, they're talking about patience and discipline. And you're going to hear that even a lot with me. I'll say with a 5 or 10 year time horizon. That's going to be exercising discipline and patience. And there's different strategies, there's different things, I should say different sectors work at different times, and there's going to be waves that this next bull market is going to experience. Things don't go straight up, they move up in waves. There'll be a wave and then it'll come back down. It'll do another wave, come back down, and do one final wave. It's generally it's a 3-wave up move. I call them impulse moves. Impulse moves are the moves that go up. And the thing that's really, I'm going to say, aggravating for most investors is that the impulse moves are very short in time. They happen quickly, and the consolidation periods are long, and they kind of wear you out. So if you want to be successful, you're going to have patience if you're going to do a buy and hold strategy, because the majority of the time on some of these, especially early in the bull market, you'll be buying in basing patterns where it's going to take some time to break out, and it may consolidate after that first wave breakout. I know everyone's going to say, well, I'm just going to only invest in wave 3. It's like, good luck to you then. Good luck timing it. Good luck selling it. Good luck all that stuff. But it's a lot more, what I've experienced is I've been a lot more successful buying the bottom of the bottom, where things are blown out. You don't have much downside risk. There could be some risk from bankruptcy depending on the companies that you're buying. And there's generally a huge runway of returns ahead of you, given a 5 to 10 year time frame. It says every speculative mania which has run its course of folly and disaster in this country has derived its original impulse from cheap money. The Economist in 1858. And what I talk about is the business cycle. And the business cycle is driven by some of this the boom bust cycle, which is credit expansion, which is hence the cheap money or cheap credit. And then you get the bust afterwards. Basically, The Economist, written in 1858, is saying the same thing that I just said there. It says, we just snorted the cheapest money crack in history. What do you all think is coming next? And there's going to be a break in those speculative sectors. And money's going to rotate away from financial assets, in my opinion, into real things and commodities and precious metals. So this guy here says 7 principles from Howard Marks on how to identify investment opportunities. So let's dive into this one. He has a lot of really good ones. So number 1, no group or sector in the investment world enjoys as its birthright the promise of consistent high returns. An asset class may become widely popular, but it's the relationship between price and value that will determine your returns. And what he means by that is you want to identify the value that is blown out to the downside, which has high value, low price, and then eventually that value in the market will materialize. People will recognize that value, where the price accurately reflects the value in the underlying asset. And that's where the investment does well, is when the value is low, the price is very high or very low. Price is low, value is high, and then the market revalues it, the price, to a better, more valued security or stock or whatever it is. But it can't do that year after year after year after year. Eventually, the price will exceed the value, and it is not a good investment anymore. And people will figure that out, and you'll get a pullback or a consolidation or something on the lines of that. So he's definitely right. He says, what matters most is not what you invest in, but when and at what price. So I think he took a lot of different sectors and companies and bought them at very good times. He says high quality companies can be poor investments if you overpay. Lower quality companies can actually become attractive investments at low enough price. So depending on the value that you get the asset for can determine how good of a return it could potentially be. The quality of the company may or may not be good. And what I try to do is I try to take high cost companies in commodity bull markets with some debt, because it provides a little bit more extra oomph to the move, invest in those, and then ride it on the way up with basically a highly leveraged rocket ship. So that's kind of what it is. So that's that. We've got the discipline which is most important in investing is not accounting or economics, but psychology. I actually talk a lot about psychology in the herd and in technical analysis. It says the fundamentals of investing are important, but investment values are driven by the psychology of the market as well as your own. And the psychology, I talk about market conditions. Market conditions are what drives the herd to behave a certain way. And money flows follow when the herd behaves a certain way. It says, the superior investor is the person who can do the average thing while everyone around is losing their mind. The ability to act rationally, not brilliance, is the edge. So basically doing opposite of everyone else. And he gets into that. Next one. The bottom line is that it's best to act as a contrarian. Whatever is popular is probably priced accordingly. You must hold contrarian views and be right about them. And it's not just to be contrarian. You have to be contrarian and be right. Agreed. It says book the bet that no one else will. On the other hand, whatever is unpopular is probably underpriced. If everyone likes it, sell. If no one likes it, buy. And what that means is it's hard to lose money if no one owns it to sell it. If everyone's already sold and no one owns it, then there's not that much to buy. I mean, not that many people out in the markets to sell whatever you're going to buy. So yeah, I agree. And that's probably the hardest psychological, I'll say, you have to be trained psychologically to do opposite of everyone else. It's pretty hard to do that. Everyone wants to hide in the herd. I'll just say that. It says, when others are afraid, you needn't be. When others are unafraid, you better be. Fear and greed run the markets, giving the rational investor the edge. As Buffett encourages, be greedy when others are fearful and fearful when others are greedy. It says, bad investors drive out good. Bad investors are willing to buy anything, driving up prices in the process for periods of time. Good investors must then be patient and willing to temporarily sit on the sidelines. So it says, these are the 7 principles from Howard Marks on how to identify investment opportunities. So there's that. This is kind of concerning here. It says, oops, job openings in construction. And it does look like the openings are declining in January. This is a big driver of employment and unemployment. And it is kind of that swing in the business cycle. So construction jobs, new housing starts, those are all positive as you're moving up. And we've got this big drawdown in construction job openings. But again, I think it's highly leveraged to the interest rate, which then is highly leveraged to what the Federal Reserve does, which is then highly leveraged to what happens in the market conditions. Here's Grady. It says, this is one of the many charts I use to call the commodities bear market low back in 2020. It says, when the second pink head and shoulders broke down, I understood that blue massive head and shoulders probably was going to play out. That's the big boy here. So once we hit this, if you look at the pattern here, guys, this is oil, light crude oil. We've been in this pullback. We're starting to get to a very cheap level and probably turn here very soon. We've done a breakout of this downtrend line, and now we did a retest. And what do we do on the retests? Everyone knows what we do on the retest. We buy the back test retest. And then eventually this, I think, will turn around, and there could be some volatility. I understand. This will probably turn around and move on higher. Oil is the #1 inflation-sensitive asset. If the government were to do something like QE, or if there's a banking crisis and they want to print money, stimulus, whatever it is, this will be highly sensitive to that money that gets created. So what this is saying is we've broken out, we've done a retest, and now it's just waiting for another stimulus package, reflation trade, whatever it may be. This does lag a little bit gold, so just watch what gold does. If gold starts taking off, I think eventually you're going to see oil take off as well behind it. Here's Tavi. He says, Brazilian equities are historically cheap, even relative to global commodity producers. The last time we saw such undervalued prices was in the early 2000s, when Brazilian stocks entered a bull market. It is one of the most natural resource-rich economies on the planet. So to recall, the commodities market is relatively small, and as large capital allocators continue to seek further exposure, Brazilian assets are likely to become a key alternative. And yellow's the Brazilian assets. The blue is the commodity producer's net total return. And I do think he is right that this will head higher with time. Brazilian equities, that is. We've got YCA, nothing wrong with this long-term chart other than it's a bit boring. So we've come on up, and we're trying to break to the upside here for YCA yellow cake. We've got iron ore. Iron ore is telling us the same story about the steel production outlook. Inventories drew sharply last week and are down greater than 16 million tons from the same week last year. Prices are back at 9-month highs, signaling market tightness in total iron ore. So iron ore inventories are dropping, and conversely, prices are starting to move on up some. So that's looking good. This is from Peter Schiff. Says, this is very bad news for the U.S. dollar and its status as the world's reserve currency. Once that status is lost, U.S. inflation will soar and living standards will collapse. I agree. This is Gold Venture. Says, on the verge of a perfect storm for monetary metals. A Fed pivot during high inflation equals real rates set to plummet. That's the upper left corner of the graph with gold soaring to all-time highs, showing the near perfect 0.82 correlation between real rates and gold. So a Fed pivot during high inflation equals real rates set to plummet. And they have to reflate, is what I think he's talking about. The R-squared value is 0.85%, which means this line that they fit to it can correlate this data with an 85% confidence level. And then we've got some other stuff that I also had posted. But we'll end it there, guys. That's what I've got for today. And hopefully you guys enjoyed the information. Give me a thumbs up. Subscribe to the channel. And definitely check out the finding-value.com website. Become a platinum member. We do have question and answer sessions that we hold on the weekends. You can ask whatever questions you want. And you can see what I have in my portfolio and the changes that I'm making in it. But that's all I've got for today. We'll catch you next time. This is Finding Value.